Hello, very good morning to all and happy Friday. I'm Kelvin here again. Welcome back to today's Daily Dose of Market Insights. Very good morning. Today will be Friday, the 27th of June 2025. So as usual, before we kickstart today's Daily Dose, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. So as usual, before we jump straight into the gist of the Daily Dose of Market Insights, which is the intraday technical outlook on all the major cross-asset classes that we cover on a daily basis, i.e. the major US dollar pair, the major stock indices, and the two key commodities asset class, which is Gold XAU/USD and West Texas crude oil. Let's have a recap what has taken shape yesterday in terms of news flow, economic data release, and as well as their impact on the intraday movement of the respective cross-asset classes. So let's start with the performance of the US stock market. So the performance of the US stock market has been rather rosy and stellar yesterday. So what I could see on my screen over here is that we see all the four major benchmark US stock indices close in the green. The SPX is up by 0.8%, the Nasdaq up by 0.94%, the Dow Jones up by 0.94% as well, and the top performer is the Russell 2000 up by 1.68%, and most importantly, all of them rallied into the entire US session. That means since a minor dip at the first half an hour of the US session, which kickstart at 9:30 p.m. Singapore time, and thereafter they actually show stellar intraday outperformance and close near the intraday high for the S&P 500, and the S&P 500 it managed to close at 6,141, which is just only 10 points away from its fresh all-time high at 6,150 level. And the Nasdaq 100 continues to be the top performer. So the Nasdaq 100, we know that is the highest beta major stock indices. That means, i.e., they are the leading in terms of performance. So if the Nasdaq 100 outperforms, it may solely create a positive feedback loop throughout the US stock market. And the Nasdaq 100 continues to push fresh all-time intraday high and closing high yesterday. So the Nasdaq 100 managed to close a fresh all-time closing high yesterday at 22,470. So previously, all-time closing high was at the start of this year in somewhere in February at 2,250. And the Dow Jones Industrial Average still has some more way to go before hitting its fresh all-time high, but nevertheless, it also powered up and closed near the intraday high by the close of the US session at 4 a.m. Singapore time. So the reason over here is that what causing this push up in the major US stock indices, despite the fact that we know that there is some kind of war of worry right now. So one of the war of worry is that from 2 weeks time at 9 of July, that will be the expiry date of the current US White House higher reciprocal tariffs. And also there was actually a news flow reported yesterday stating that, okay, give me a minute, where was it? Okay, 1 second, let me open up this news flow stating pertaining to the trade tariffs, stating that country-wise actually facing a roadblock is because due to, 1 second, where is it? Okay, let me second. Yes, this is the one. All right, so one of the reason it seems to us that there is no kind of, we call it clear signs that countries that are right now doing one-to-one negotiation with the US is we call it stating any positive outcome right now, because right now there's this trade tariffs ongoing one-to-one with the US, Japan, India, and the EU. So they are actually stalling because these countries do not know how they will be affected by the separate levies on export like chips, drugs, and steel. So don't forget, the current US White House administration right now has introduced a slew of complicated tariffs. One is it will impact throughout all services and we call it export or imports, and there's another one that is being separated uh, based on product wise. All right, so the reciprocal tariffs is a broad-based one that Trump is having a 90-day pause with all the countries until 9th of July. So these countries are negotiating to reduce these higher reciprocal tariffs on top of that broad-based 10% tariff that Trump wants to actually be implemented universally, right, throughout all the countries that is trading US. And on top of this broad-based tariff, Trump also implement tariffs based on sectorial and products. That means there will be separate tariffs, one on chips, drugs, and steel. So because of this separate kind of tariffs over here, countries that are doing one-to-one negotiation with US, like Japan, India, and EU, are stalling their negotiation process because they are unsure how these separate reciprocal tariffs, product-wise, will be impacted on their outcome of this ongoing trade negotiation process over here. So despite this negative news flow, stock price continues to push up higher. So one of the reasons why stock price pushing up higher is because of the potential increased liquidity into the US economy. So why do I say that? Because if you look at the current CME Fed Watch 2 over here, so on the CME Fed Watch 2, still very high chance that the Fed funds futures market traders is still pricing in 77% odds that the Fed will not do anything in the next FOMC meeting that is on 30th of July. So this is has already been baked in the sand. So nothing much, pretty much changes. So yes, last week was 87%. Now it dropped by 10%. Okay, lower. Okay, lower by 10 percentage point. But what's interesting over here is that as we push down the curve, by looking at the aggregated tab over here, that means by looking at the probability of all the others FOMC meeting down the calendar. So the next one right now, we have a very high probability that the Fed will start to cut or implement its first rate cut in 2025 in September instead of October now. So previously, September was a very low ball number, less than 50%. So right now, it's a high chance of 88% that the Fed will do the first cut for 2025 on the 17th of September 2025 FOMC meeting to bring the Fed funds rate down to 4% to 4.25%. So that's a 25 basis point cut. And what's interesting over here is that the next cut, the second cut, also a very high chance of 83% that will come in on the 29th of October 2025 over here. So, and that brings down the Fed funds rate to 3.75% to 4%. And what's interesting right now is that we have a high chance of, slightly high chance of more than 50%, or I would say that more than 55% at 63% that the Fed will engineer the potential third cut before 2025 ends on the 10th of December 2025 FOMC meeting to bring down the Fed funds rate further to 3.5% to 3.75%. So what market participants right now is assigning a higher probability that the 2025, by time 2025 ends, the Fed funds rate will be at 3.5% to 3.75%. That implies a potential 3 interest rate cut of 25 basis point each, which is an incremental of one more interest rate cut that was previously priced in the last 3 to 4 weeks. All right. So because of this market pricing of expectation of more liquidity will be added into the US economy. So with more liquidity, that potentially seek out what I call risk-taking behavior. So that actually causes the US stock market to actually rally yesterday, despite that we are actually climbing out a wall of worry, right, which is number one, there is no clear signs that the ongoing negotiation with the key trading partners of US, like India, Japan, EU, that they are doing any positive, we call it headways, as we approach the 9th of July expiry date for the higher reciprocal tariffs. And also what causes the increase in expectation of the Fed funds rate cut by by the we call it pricing of the potential third cut this year. much more dovish than what was being penciled in by US Federal Reserve officials in the recently concluded FOMC meeting 1.5 weeks ago, where they only expect only 2 interest rate cut in 2025, is because of the labor market in the US is getting more and more lackluster, and I would say even weaker. All right, so yesterday was there this weekly continuation so-called a claim. All right, so this recurring, or I'll say continuous jobless claim, so it's a weekly thing, so it's a kind of a accumulated one. It's a recurring jump to the highest since 2021 over here. So recurring application for US employment benefits rose to the highest level since 2021, signaling more people are staying out of work for longer over here. All right, so it burst, this was recurring, yeah, so this recurring one shoot up all the way to 1,974K amount of recurring jobless claim, and that's the highest level in 3.5 years. So that pointing to a rather soft labor market, or a lackluster US labor market, indicating there are more people out of jobs potentially, and that could potentially turn the pendulum of US Fed Chair Powell. Especially, he keep on mentioning that he wants to be more data dependent, and this current data in the US job market is pointing for a fast forward, or bring forward, that potential interest rate cut that the Fed wants to implement in this year. All right, so that also causes the Fed funds futures market to price in one more additional cut, a total of 3 in all, before 2025 ends over here. All right, and also another reason over here is that that potentially linked to the replacement of Fed Chair Powell, because was it? Yeah, over here. So the dollar fell yesterday, and the US Treasury rallied after a report stating that US President Trump is considering naming Fed Chair Jerome Powell's successor well before the incumbent term is scheduled to end in next May. So we know that Fed Chair Powell, his term on the Fed will expire in next May 2026, but because US President Trump is showing a lot of distaste about the way how Fed Chair Powell's conduct monetary policy, that going against his wishes, where he wanted to have a lower interest rate, that actually causes a bit of a hoo-ha right now, and he keep threatening Powell's independence, or the Fed independence, and he also threatened to remove him before his term ends, because based on constitutional law, Fed President Trump could not do that. So what he could do is actually create a potential shadow Fed chairman way ahead of Jerome Powell we got terms end in May next year. So he kind of remove the influence of Jerome Powell influence on the Fed right now, by naming him his successor way before his terms end in May 2026. So that create what I call a potential dovish Fed going forward, and market tends to be forward looking, and that also causes the Fed funds futures market to price in one more additional cut before 2025 ends over here. All right, and before we go, let me share with you other job data we could share over here. So other data that has taken shape early this morning. So in early today's Asia session, we have the Japan data, which is a Tokyo core CPI data, and the Tokyo core CPI data that was released at 7:30 a.m. Singapore time. So this data is rather important. Why? Because it's a leading inflation data for the Japan nationwide inflation trend. Okay, so the Tokyo one tends to report 2 weeks first before the Japan nationwide CPI data. So for the Tokyo core CPI data year on year, yes, they are still holding above a BOJ target of 2%, but it slipped down lower than expected. Right. So initially it was at 3.6% year on year for the month of May, and in June it kind of slowed down its growth to 3.1%, way below what market expecting at 3.3%. And that one excluding energy, which is export and energy, the core CPI also dipped down lower as well over here. So it was at 3.3% previously, that was revised upwards from 2.1%, and it dipped down lower to 3.1%. And what's interesting over here is the retail sales year on year. So retail sales year on year also slowed down in Japanese retail sales. That talk about consumer spending. For the month of May, it slowed down to 2.2% from 3.5% that was previously reported in the month of April, and that was also below expectation of 2.7%. So what we could see over here is that a slight slowdown in inflation growth of Tokyo and a slowdown in retail sales growth. So that actually kind of give us an indication that the Japanese economy right now is getting a bit softer because of the risk of tariffs that could create a negative feedback loop into the US, the Japanese economy, pardon me. So that actually kind of prevent people from spending that much as well. So because of this potential slowdown in Japanese economic growth due to that tariffs up from the US or the tariffs uncertainty of US, that could actually prompt BOJ to be less hawkish in normalizing its interest rate normalization policy. So bear in mind, Bank of Japan now is slowly hiking rates since 2 years ago, and potentially there could be one more interest rate hike before 2025 ends. But given that if the economy starts to weaken or slow down further, signs of slow down further in the Japanese economy, the Bank of Japan may choose next year to introduce another interest rate cut, a hike instead, not cut, a hike instead, rather than doing one more before 2025. And so that actually also create a bit of liquidity into the into the Japanese stock market. So if you look at the Japanese stock market yesterday, I do mention that after that bullish breakout of that so-called 7-week range ascending triangle range configuration, it continues to rally very strongly, up by 1.6% as we are speaking right now over here. Okay, let me share the chart. Yeah, so it continues to rally very strongly. So later I'll cover what are the short-term intraday technical levels to watch out for the Japan 225, which is the representation of the Nikkei 225 thereafter. And what's interesting over here is now moving on to the FX market. So we know that if BOJ were to be less hawkish and kind of hold back their normalization interest rate policy plan, that means by pushing down the potential interest rate hike in Japan from this year to next year. The potential there will be one more. Initially, it was priced before the year 25 ends, and because of the weakening state of the Japanese economy by that lackluster retail sales, and also a kind of a slowdown in growth of Tokyo CPI trend, that could potentially see BOJ hiking rates starting next year instead of the third quarter or fourth quarter next year. So that by right should be very strong for the dollar yen. That means the yen should be weak against the dollar. But what we could see in the FX market right now is the yen continues to remain strong against the dollar. It means the dollar yen continues to dip down after that initial push up at the start of today's Asia session. So the dollar yen now is actually down negative 0.07% on the intraday basis. But if you look at the 5-day rolling performance of the dollar as measured against the major currency as we are speaking right now, the dollar yen is actually down by negative 1.44%. So what we could see right now in the US dollar perspective is that we start to see a broad-based dollar weakness, except against the CNH, which is being controlled by PBOC, of slowing down the pace of the dollar against the Chinese yuan over here, because that also the intention of Bank of China PBOC is to actually, they do not want to have a strong CNH. Why? Because a stronger CNH will kind of reduce the demand of their export, which is still pretty much needed to grow their 5% annualized GDP target, given the fact that consumer spending is not that robust in China at this juncture. All right. So, but however, the rest of the other major currency continues to strengthen against the dollar, or i.e. the dollar continues to weaken against the other major currency as we are speaking right now. All right. So that potentially, yeah, sum up the first segment of the daily dose over here. And now let me cover the second segment with us, which is the intermarket dynamics that is pertaining to the US stock market. So what we could see over here is at the top of the chart will be the highest beta so-called major US stock indices, which is the Nasdaq 100, which comprises of the mega cap technology growth stocks that have more than 50% weightage in the Nasdaq 100 benchmark index, and the bottom will be your traditional Dow Jones Industrial Average, which comprises more of banks, industrial related stocks that has a higher weightage overall as compared to the technology growth stocks or the mega cap technology stocks with the likes of Nvidia, Microsoft, and Amazon, even Google, Alphabet. So what you could see over here at the bottom is the relative strength chart of momentum-based S&P 500 ETF and a value-based S&P 500 ETF. So what this ETF does over here is that they rejiggle the weightage of the S&P 500 and weight them accordingly to momentum factor. That means S&P 500 component stock that has a highest momentum reading or factor based on certain rate of change metrics that the compiler, the ETF compiler, we call it decides. They weigh them accordingly and rescale the S&P 500. So those S&P 500 component stock that has a higher momentum score will be ranked at the top, and those who have a lower momentum score will be ranked at the bottom. So instead of the traditional market cap weightage, they actually weight it according to momentum factor. And similar for this as well, it's the same S&P 500 component stocks name, except that right now the compiler decided to rank it according to value. So we know that value represent PE ratio that is relatively low. So with those component stock that has a forward-looking 12-month forward PE ratio that is lower in value, will consider as being much more valued than overly richly priced high PE ratio component stock. So those stocks that has a higher value factor weight accordingly to valuation metrics will be ranked at the top in this S&P 500 enhanced value ETF. So what I could see over here is that since 31st of March this year, where the previous we call it medium term corrective decline ended on the Nasdaq 100, the momentum S&P driven ETF continues to outperform strongly against the normal market cap weighted SPF, whereas the value weighted S&P 500 ETF continues to underperform as it continues to shape a series of lower high. So what you could see over here is that at this point in time, as long as it's a momentum driven situation right now, so momentum factor is actually leading the pack, and once momentum factor leads, it create a positive feedback loop into the general US stock market. So based on the intermarket analysis perspective, based on how I look at things from a relative performance basis by looking at the momentum SPF 500 performance against the market cap weighted S&P 500 performance, and compare it with the relative strength of the S&P value ETF performance with the market cap S&P 500 performance. What we could see is that momentum is leading very strongly right now, and with the strong lead of momentum factor based S&P 500 ETF, that could potentially see a further positive feedback loop into the US stock market, at least from a medium term perspective. Let me talk about multi-week perspective. So I got to respect this momentum strength that is building up in the US stock market, despite the fact that we have a slew of war of worries to actually consider, especially with the expiry date of the higher reciprocal trade tariffs that is imposed by the US White House is coming to its expiry date soon, which is 9th of July. Right, so this is the we call it intermarket analysis that I want to share with you all, more pertaining to the situation of the US stock market right now. Okay, so with that, now let us now jump to the next segment of the daily dose of market insights, which is the intraday technical outlook. All right, so before that, let me expand my screen. Okay, so now let me now start with the FX market. So before we start with FX market, I want to share with you the US dollar right now is at a very, very critical juncture. So this chart I already shared since the start of 2 days ago, where I covered my daily dose. To follow my daily dose. So this is the monthly chart of the US dollar index. All right, so we know that the monthly chart of the US dollar index has been trading in the long-term circular ascending uptrend since the channel low of May 2011 over here. Okay, in this turquoise blue turquoise green channel. And right now, the current price action is actually breaking down this channel, which is acting as a support at 97.40. So now we are at a very critical juncture. Price action on the US dollar index is quoting at 97.25. So why I use US dollar index? So take it away that US dollar index is a kind of a gauge of market sentiment on whether the dollar is strengthening or the dollar is weakening from a general sentiment perspective. So instead of looking at individual major US dollar pair, I can one shot look at the US dollar index to gauge whether the dollar is actually having a bullish sentiment or a bearish sentiment on the aggregated perspective. So what we are seeing right now, the dollar is having a bearish sentiment on the aggregated perspective, and the bearish sentiment of the US dollar is now pushing towards a very key critical level, which is 97.40. Why this 97.40 level is very important? Because it's a major support that is in place since May 2011. So that was talking about what, close to 14 years over here of uptrend, long-term circular uptrend. So if we have a weekly close below 97.4 this week, which is today, Friday, and potentially that could kickstart a multi-week to multi-month downtrend phase of the US dollar. So going forward, the US dollar seems to be skewed towards on the weaker side from a longer term perspective. Yes, on the intraday basis, you may see the dollar bounces here and there because price action don't go vertical down or vertical up. So that's why we have the daily dose of market insights for you guys over here to look out for short term technical outlook on those major cross asset classes that we cover on the daily basis. But from a longer term perspective over here, the dollar is now at the brink of breaking down a key major support, which is 97.4. A weekly close below 97.4 potentially increase the odds of a multi-week to multi-month downtrend phase for the US dollar. All right, so with that, now let us now jump straight to the intraday technical outlook on the euro dollar first. All right, so on the euro dollar, what we could see over here is that price action hit our first support, hit our resistance zone at 17.25, 17.50 before inching back downwards. Overall, no signs of a bullish exhaustion yet. Why? Because the hourly RSI continues to remain in a positive bullish momentum condition as it's managed to bounce off this parallel ascending trend line support and also hitting above the 50 level mark again as we are speaking right now. So with that, we will now still maintain our intraday trend bullish bias on the euro dollar using a tightened short-term pivotal support level for today at 116.60. So 116.60, if you do the Fibo retracement of this ongoing impulsive bullish uplift since 23rd of June low, that constitute close to 23.6% Fibo retracement. So as long as 116.60 tighten short-term pivotal support holds for today, maintain intraday trend bullish bias for the euro dollar. Above 117.50 exposes the next intermediate resistance, which is a cluster of Fibo extension level at 170.80, followed by 118.10, 118.25 next. All right. So two resistance level to watch, 117.80 in first step next, followed by 118.10, 118.25. Only an hourly close and a bearish breakdown below 116.60 that would invalidate today's intraday trend bullish bias to kickstart a minor corrective decline, exposing the next near-term support level at 116.25, followed by 115.80 next. Next up will be the sterling pound. The sterling against the dollar also continues to rally, hit our first resistance yesterday, did only a minor pullback, and right now during the Asia session, it continues to push higher. And what we could see, the hourly RSI continues to remain bullish above this ascending trend line support, holding above 50 level mark. So far, yesterday, it went up to the overbought level, no bearish divergence upon hitting the overbought level as well. So net overall, bullish momentum condition, short-term bullish momentum condition still prevails in the sterling dollar as expressed by the latest observation that I described on its hourly RSI. So with that, I will have a tightened short-term pivotal support for today on the sterling dollar using 136.70 as my short-term pivotal support. Above 137.50 exposes the next resistance level at 138 figure level, 138.30, 0.764 Fibo extension from the low of 23 of June. And the next level to watch out for will be at 138.70, which is the one-time Fibo extension. All right, only an hourly close and a breakdown below 136.70 tighten short-term pivotal support for today on the sterling dollar that would invalidate today's intraday bullish bias to kickstart a minor corrective decline, exposing the next near-term support level. First support level, next support level to watch in first step, 136.30/35.70. If it breaks down below 135.70, it may see a deeper minor corrective pullback to retest the 20-day moving average, confluencing at the next near-term support level at 135.30 next. Right, so that's for the sterling dollar. Next up will be the Aussie dollar over here. So the Aussie dollar, like I explained, we do anticipate the bullish breakout. The bullish breakout takes shape right exactly we are speaking as yesterday at the start of the US session, cleared above this level here. Let's go to the daily chart. Okay, cleared above this 65.35 level. All right, so what that represent is that represent a close to this 2 months plus of complex sideways range bullish breakout over here, right, on the Aussie dollar. And also the hourly RSI also managed to break out above its parallel descending trend line as well. Still has some more room to go before hitting the overbought level, indicating that the medium term bullish momentum has starts to revive on the Aussie dollar. So with that, we will still maintain our intraday trend bullish bias for today on the Aussie dollar, using the Titan short-term pivotal support level at 65.10 for today, which is the former minor swing high of this Tuesday and this Wednesday. First support level to watch will be the former 2 months plus of sideways range resistance now turns into a pullback support at 65.46, 65.37. Above 65.65 exposes the next resistance level at 0.66 figure level, which is also close to the 0.764 Fibo extension taken from the low of 23rd of June, and also psychologically level as well, 66 figure level, and it also confluence with the 11th of November 2024 swing high area. Only a bearish breakdown and hourly close below 65.10 that would invalidate today's intraday trend bullish bias, and also invalidate the bullish breakout scenario to actually revive the choppy decline scenario, choppy minor corrective decline sequence again, exposing 64.80, which close to the 20-day moving average, and below it may see 65.55, 64.40 coming in next, which confluence with the rising 50-day moving average. So that's for the Aussie dollar, still maintaining our intraday trend bullish bias after that bullish breakout has taken shape yesterday. Right now, with an adjusted upwards short-term pivotal support, will be at 65.10. Next up will be the dollar yen. So the dollar yen, despite the weak weak Japan economic data up from early morning today's Asia time at the 7:30 a.m. mark, which is the Tokyo Core CPI, the Tokyo Core CPI, and as well as the retail sales, which is weaker than expected, market chose to actually plummet instead of going up. So the US dollar, the dollar yen is now moving in sync with the general dollar weakness that is taking shape right now. All right, so with that, the price action now managed to react off the 20-day moving average, hit our first support level at 143.90 before staging that bounce. So this bounce itself also bounced up because the dollar yen managed to test a medium term range support level since the low of 23rd of April. All right, so since 23rd of April low, the dollar yen has been trading in this kind of complex sideways range configuration. So it could be also a symmetrical range triangle as well, because as we see a series of higher low and lower high of it, this higher, lower, and this high, but it's quite volatile in this symmetrical range triangle. So I would say it's a complex range configuration. So what I could see over here is that the hourly RSI continues to be kept by a parallel descending trend line over here. So with that, I will have a Titan short-term pivotal resistance for today at this previous bearish reaction level at 145.20 that took shape yesterday. So if you do the Fibo retracement of this last push down from the high of 25th of June all the way down to the intraday low of yesterday's European session, that also coincides with the golden ratio very closely at 61.8%. So using 154.20, that will be my adjusted downward pivotal resistance level on the dollar yen. Maintain our intraday trend, maintain our intraday bearish bias for a retest below 143.90. If we see a breakdown below 143.90, then potentially that could be a medium term range bearish breakdown scenario, exposing the next intermediate support in first step at 143 figure level, psychological level, and as well constitute the minor swing low of 5th of June and 13th of June. Only a bullish breakout and an hourly close above 145.20 that would invalidate today's intraday bearish bias on the dollar yen to see a squeeze up towards the upper limit of this complex range configuration. Watch out for the next resistance to come in at 146.25, followed by 147.15 next on the dollar yen. Okay, so that sum up the intraday technical outlook on all the major US dollar pair. Let us now turn our focus to the major stock indices, starting with the Hong Kong 33. Over here, so the Hong Kong 33 continues to trade sideways between our first resistance and our first support level at 24,490 and 24,240. So given that it can't break out above 24,490, we will still be keeping our pivotal support level at 23,880 to maintain this intraday bullish bias on the Hong Kong 33. Above 24,490, potentially see the next resistance coming in at 24,850, which coincides with the upper limit of this ongoing minor ascending channel that is in place since 30th of May, and as well as the medium-term swing high area of 18th of March and 19th of March this year. Only a bearish breakdown below 23,880, which will coincide with the rising 20-day moving average, that would invalidate today's intraday trend bullish bias to kickstart another round of minor corrective decline sequence again, exposing the next near-term support level at 23,690/23,560. Below it sees 22,260 next, which confluence with the rising 50-day moving average and as well as the lower limit of this minor ascending channel. So that's for the Hong Kong 33. Next up will be the Nikkei 225 or the Japan 225. Continue to squeeze up, hit our resistance level. RSI now is at the extreme overbought level of 87% or 87 level. So I think that is the highest level so far. If we go back in time in the last 3 months or so, yeah, that's the highest level in almost 3 months, right, at 87. So with this rather high overbought reading of the hourly RSI over here, there could be a risk of a minor pullback. So given there's no bearish divergence on the hourly RSI over here, as the hourly RSI continues to print out a higher high, okay, so there could be a lower risk of a deeper minor corrective pullback. So with that, I would potentially shift my pivotal support for today. So first resistance level, first support level to watch will be 39,900 level, which is the breakaway line over here of this the start of this bullish Marabozu and the end of this doji candlestick, all right, over here. So this is coming like a breaking line. So that will be my first support level to watch, 39,910. Pivotal support will be at this minor congestion area here that has been formed at the start of yesterday's European session, where there's a slight dip before inching up higher during the entire US session yesterday. So this will be my pivotal support level for today, adjusted upwards one at 39,560. And if you do the Fibo retracement of this start of this impulsive up move leg from 20th of June over here all the way up to the current intraday high, that is slightly below the 23.6% Fibo retracement. All right, so using this level, 39,560 short-term pivotal support level, as long as this level holds, still maintain that intraday trend bullish bias after a potential minor dip on the Japan 225. Next resistance level to watch after 40,280 will be 40,620, followed by the 2 times Fibo extension taken from the low of 13th of June at 41,050 next. Only a bearish breakdown below 39,560 will trigger a deeper minor corrective decline sequence, exposing 39,145 before the all-important pullback support level at 38,850. That was the former 2-week plus of ascending triangle resistance at 38,850. Now turns into a critical pullback support level. So that's for the Japan 225. Next up will be the Germany 30. So the Germany 30 continues to maintain its bullish momentum over here after that test on our pivotal support and a rebound of it. Hourly RSI also continues to show signs of a bullish momentum over here. There is no sign of a bearish divergence at all. Price is going to inch higher high and higher low at the bottom. Okay, so with that, maintain our bullish bias stance because since it hasn't broken out above 23,880, I'll be still using our pivotal support level at 23,510, 23,440, which is a very critical support where it managed to shape this bullish curvature move in the last two sessions on Thursday as well. All right, Wednesday US session and Thursday US session. All right, it managed to shape this two curvature bounce of it. So unless we have a clear bullish breakout during the start of the European session with an hourly close above 23,880, then that I could potentially tighten the pivotal support level to this breaking line over here at 23,630. So level still remains the same because it hasn't broken above 23,880. So still using 23,510, 23,440 as my short-term pivotal support level. Above 23,880 exposes the next resistance level at 24,110, followed by 24,260, which is the one-time Fibo extension of this ongoing impulsive up move on 20th of June, and as well as the graphical resistance level of 6th of June and 10th of June. Right, only a bearish breakdown below 23,410 that would invalidate today's intraday trend bullish buyers to see a choppy corrective decline move to expose 23,280. Below it sees the minor swing low area of 19th of June coming in at 23,020. All right, so that's for the Germany 30. Onwards next will be the major US stock indexes, starting with the US Wall Street 30 representing the Dow Jones Industrial Average. So price action cleared above our short-term pivotal resistance level. It stayed at 43,160 and also cleared above this so-called ascending wedge resistance as well, the dotted green line over here, indicating that lower chance of a corrective pullback taking shape. And right now we are doing a very strong impulsive wave 3 movement. That means this is minor impulsive wave 1, minor impulsive. So this will be the, let me share with you guys. So this will constitute as a minor impulsive wave 1 over here. Then this will be that corrective wave 2, where the retest of this support level at 41,970 on the onset of the Israel-Iran conflict. Then after that, once the conflict resolved, price action continues to pierce up very strongly. And right now we are in the midst of this impulsive wave 3, where all the pullback is very, very shallow pullback instead of a deeper pullback. So since the bullish breakout of the pivotal resistance yesterday, the odds of a deeper minor corrective pullback has been more or less eradicated, as price action on the US Wall Street 30, we got to respect it, doing this impulsive wave 3 sequence. So given this impulsive wave 3 sequence, pullback will be very minor. So yes, the hourly RSI is in the overbought level right now, so there could be a minor pullback. Retesting the ascending wedge resistance now turns into a pullback support level at 42,290, and we'll be using this minor congestion area that was formed on Wednesday yesterday to be my pivotal support for today at 43,160. So as long as this minor pullback didn't surpass below 43,160, we will flip to a intraday bullish bias on the US Wall Street 30 for today. Next resistance level to watch will be 43,750, which is the Fibo extension cluster level, followed by 44,020 and 44,220, which is the 0.236 Fibo extension, and as well as the minor congestion area of 13th of February and 24th of February over here. So only a hourly close below 43,160 that would invalidate today's intraday trend bullish bias to kickstart a deeper minor corrective pullback towards 42,860 and even 42,650 slash 42,480, which confluence with the 20-day and the 200-day moving average. Next up will be the S&P 500. So the S&P 500 is also doing this impulsive wave 3 sequence as well, where all the pullback will be very, very shallow. We could see over here. So this will be the 1. This will be the 2. And right now we are in the midst of a 3 over here. Okay, so with that, now it's actually hitting a fresh all-time high. Previous fresh all-time high was 6,151. So with this break of this ascending wedge resistance level, this dotted gray line here. So that actually signified the movement of this impulsive wave 3 or the S&P 500, and we got to respect it. That means, i.e., the pullback will be rather shallow than deep. So first pullback level to watch out for will be at the pullback of this ascending wedge, now turns into a pullback support at 6,136 level, and slightly below it will be 6,110. So 6,110 is the congestion area that was formed in yesterday before that bullish impulsive move that takes shape in the entire US session yesterday. All right, so with that, that also constitute close to the 23.3%, 23.6% Fibo retracement as well. So using 6,110 as my short-term pivotal support level on the SPX 500 for today, still maintain my so flip to a intraday bullish bias for this impulsive wave 3 sequence to play out above 6,175/6,190 exposes the next resistance level at 6,250 next. All right, only hourly close below and a breakdown of 6,110 that would invalidate today's intraday bullish trend bullish bias to kickstart a much more deeper corrective decline towards 6,070, followed by 6,050/6,030, maximum 6,005, which constitute with the overlap of that wave 1, and as well as the rising 20-day moving average. So that's for the SPX 500. Next up will be the Nasdaq 100. So the Nasdaq 100 also doing this impulsive wave 3 sequence as well. Bullish impulsive wave 3 sequence, where this is the 1, this is the 2, and right now we are shaping that 3. Okay, so for that, the pullback will be rather shallow rather than deep. So what we could see over here is that it's now testing the next resistance level at 22,520. So that could be a minor pullback taking shape. So pullback level to watch will be this dotted gray line here again, which is the bullish breakout of the ascending wedge resistance. Now turns into a pullback support at 22,340. So using yesterday's congestion area, which is the minor swing low area of the start of the Asia session, the minor swing low area yesterday. All right, yesterday during the US session, that means the US session low yesterday at 22,234. So this will be my pivotal support level for today, 22,234. Next resistance level to watch will be 22,710. Then thereafter followed by 22,885, which is defined by Fibo extension levels. All right. Okay, 22,885 next. Only a bearish breakdown and hourly close below 22,235 that would invalidate today's trend bullish bias to kickstart a deeper minor corrective pullback, exposing 22,065, 21,990, maximum 21,750, which is constitute the rising 20-day moving average as well. Okay, so that's for the Nasdaq 100. Right, so now let us move on next to the commodities asset classes, starting with the gold XAU/USD. So for gold XAU/USD now is breaking, is very weak. So despite the dollar strength over here, a dollar weakness, gold is not actually pushing up. So it seems to us that there's a rotation play going on. So previously gold is being used as a safe haven demand, but unfortunately because of that risk on scenario that's being seen on the major US stock market, so there could be a rotation from gold into risk on proxy instrument, which is equity. So gold right now is now breaking below our 3,300 short-term pivotal support level. So with that failure to break out above the 20-day moving average at 3,346, so right now there could be a deeper corrective move taking shape in gold right now. So with that, I got to flip to a bearish bias for today to respect the current price action in gold. All right, so this level is actually breaking down right now, 3,300. Okay, so the next support level to watch will be 3,270, 3,250, which is the medium-term ascending trend line from 31st of December 2024 low. So if it starts to break down below 3,250, then potentially we may now start to see the multi-week medium-term downtrend phase taking shape on gold XAU/USD. We in a major uptrend phase that is still intact, exposing the next support level at 32.05, which is the minor congestion area of 16th of May and 20th of May. All right, only a bullish reversal and the hourly close back above 3,346 will revive back the boost to expose 3,400 level. All right, so for gold XAU/USD, based on the current price action, which is breaking below 3,300, so like I explained, is due to a rotation play from safe haven demand shifting onward next to risk on assets like equities. Gold may now starts to see a deeper corrective pullback move. So for an intraday perspective, we will flip to a bearish bias using 3,346 for sure as my short-term pivotal resistance level. Next support level to watch 3,270, 3,250. Below it exposes 3,205 in the first step. So that's for gold XAU/USD. Next up will be the West Texas crude oil over here. So West Texas crude oil, what we could see, continues to actually trades slowly inching upwards over here. The hourly RSI has now starts to slope upwards as well. So with that, we'll be still maintaining a intraday trend bullish bias for a mean reversion rebound scenario to take shape, using the support level at 64.05, which is the 50-day moving average. Above 67.67 exposes the critical resistance level at 69.15, 70.60, which is also the 200-day moving average. Only a breakout above 70.60 will see a potential recovery in West Texas oil. So unless that level breaks out on the upside, we will now only view this bounce up as a corrective bounce or a dead cat bounce before another bearish move takes place on West Texas oil. So however, if price action, instead of going upwards towards 70.60 and it starts to break down suddenly and with an hourly close below 67.05, then the impulsive downward sequence will continue, exposing the next near-term support at 62.50, followed by 60.30 in the first step, which is the 30th of May minor swing low. All right, so that sum up the intraday technical outlook on all the broad-based cross asset classes. So before we go, let's have a quick look at the economic calendar. What are the key data to look out for today? So today, important data will comes in the later part of the European session. So at 5 p.m. Singapore time, we have the economic sentiment data from Eurozone for the month of June. So market is expecting a slight improvement from 94.8 to 95.1. So that will be at 5 p.m. Singapore time. And thereafter, we will have a Federal Reserve official speaking at 7:30 p.m. Fed Williams, and followed by the all-important US Federal Reserve favorite inflation trend metrics in the US, which is the core PCE price index. So for core PCE price index, month-on-month market is expecting the same rate of change at 0.1%. Whereas for the core PCE price index on the year-on-year basis, market is expecting a slight uptick to 2.6% from 2.5% from the previous month of April. So something to look out for. That will be at 8:30 p.m. So that could potentially influence almost all the major cross asset classes, because this is the favorite inflation gauge that's being watched by the US Federal Reserve. And thereafter, that will be a quiet session. Also, that bear in mind over here is that today will be the last day of the China National People Congress Standing Committee meeting. So do look out for any potential news flow that could actually report. Would there be any so-called bringing forward or front loading of physical stimulus, expansionary stimulus plan out from China to negate the potential trade tariffs negative impact on the Chinese economy? So that could be potentially at the end of the Asia session today, if there is any, around 4 p.m. to 5 p.m. Singapore time. All right, so that sum up the intraday technical outlook and the daily dose of market insights for today. I'm Kelvin here, signing off. I wish you all a restful and a great weekend, and we shall speak again on Monday. Thank you.